Hello everyone, welcome back to my YouTube channel. My name is Rajat and today we are going to talk about a very important aspects of credit risk. In credit risk, we have been usually talking about retail credit risk, like all the retail products of the bank, like credit card, loan, mortgages, auto loans, car loan and everything, right? Today we are going to touch upon business to business loans. These are pretty much different compared to a retail credit risk. So that is something we are going to discuss today. Okay. Now, first of all, what is the meaning of B2B here? So B2B stands for business to business. When there is a bank and bank is lending money to another company who's building some infrastructure or building some new technology, or they are taking any kind of loan, right? So that is totally known as business to business lending. So for example, if I take an example of any tech company, let's say Infosys, they want to build a new campus somewhere, let's say, so they are buying some land and then they would be building some infrastructure. So for all that, they need 3,000 crores. Now they don't want to invest, or they are not in position to invest that much of money. So they would be taking some loan from the bank. So now this bank, let's say HDFC Bank, is paying to Infosys a loan of 3,000 crores, maybe in terms of some collateral. They would be taking the land, they would be taking in terms of collateral, right? So now this kind of loan is known as B2B lending. Okay. So now, after B2B lending, the credit risk which is involved, that Infosys may not be able to pay the money, that is known as B2B credit risk. So you can say, like, when a company is giving to another company, or company is giving to another small business or medium scale business, that is known as B2B lending. While in the retail credit risk, there were only customers involved, like you and me. We are the individual customers. So we are taking a home loan or something like that, personal loan, credit card, mortgages, all of that. Now, let's talk about a little different between B2B credit risk and B2C credit risks. So first of all, here we are trading the corporate loans. Corporate loan is the biggest portfolio across here. And sometime we finance the supply chain of any company. So these are two examples here. Now in B2C, the biggest example is credit card, number one, and then mortgages. Mortgages, all of us understand. Now in B2B, there are certain things which you should also recall, like what type of data is used in B2C. So B2B versus B2C. So in B2B, you will have the financial statement and the GST statements and other bank submissions which the company is having, let's say Infosys is having. Okay. Now in terms of B2C, the bureau score, income of the individual, demographic information, all those things are very important. Now, there are some important models which we use, right? So in credit risk normal B2C, where you have the normal retail credit risk, we score credit scorecard, we use behavior models, and then we calculate the things. Now in terms of B2B, we calculate the rating models. We use scorecard here also, but slightly differently. Then we build the PD models again, and then early warning system if a company is going to collapse. That is very important. Now the biggest difference is this business and this is customer. Okay, so this was a brief information about overall level. Now there are variable difference, there are behavior variable difference, external variable which bank purchase. On all of those level there are differences. That is again very important, we all should know. Now I would be taking one example which I have noted here already, that let's say there is a company, Prestige is building a Prestige City in Bengaluru, right? So they want to invest a huge amount of money, let's say like 10,000 crores to build that whole big infrastructure. Then they have, let's say, 3,000 crores in their pocket, but 7,000 crores they would be taking a loan. Now this is something we would be discussing in this video, end-to-end banking perspective side, and I'll tell you the whole life cycle. Now this life cycle is divided into 17 steps, which I have noted down here. So in this video we would be talking, so this is only the high level information. We will be going each step by step. This is overall level. So first is the deal origination. Okay, that's pretty much self-explanatory. I'll just give one or two liner about them. We'll talk much more in detail. Then will be due diligence of the loan which is going to disburse and the due diligence of the customer, the Prestige group, let's say. Then project feasibility assessment bank will be doing. Then financial modeling. Now here are the most important metrics, credit risk metrics in B2B lending. So all of them have their individual meaning. We'll talk about that in a while. Then internal credit rating will be checked. Then PD estimation will be there. Then credit approval process will come into the place. And then loan structuring, what would be the structuring of loan. At each phases there would be some disbursement, so that will be discussed with the bank and the builder. Then there will be syndication and consortium concept. It's very important, I'll tell you. Loan disbursement will happen. Then construction monitoring bank will be doing continuously. They will set up a early warning system in case the company is going bankrupt or any other issue is rising. Then IFRS 9 or ECL calculation under IFRS 9 will be taking place. And then loan repayment or portfolio monitoring will be done by the bank. Then they will be doing restructuring if any unwanted situation happens. If the project is not able to fulfill because there are some issue with the Prestige group, let's say, for example, this is just a hypothetical situation. If there are some issues, financial issues, there are leadership restructuring. So in that case, usually company don't perform very good. So bank always try to restructure the loan to remove the stress from the system, right? Then there will be either default or recovery. It's not mandatory that default and recovery will happen, but bank usually try to focus on these steps when they are making a B2B credit risk model. Okay. Now these were the steps. So in B2B credit risk, there are different type of variables which are used compared to B2C. So let me give you a brief about those variables. So revenue growth is first. The growth in the revenue and pretty much self-explanatory. So these are the financial variables. First, I'll tell you the financial one. Financial variables. Revenue growth, then EBITDA. EBITDA is again a very important metric. You should read about this. This is a statistical concept. Then net profit margin. What will be the net profit margin? Okay. Then debt to equity ratio. Debt to equity, like how much debt they are taking, compare they are putting some equity to the bank so that bank have some rational. Okay. Then the most important from the interest perspective is interest coverage ratio. Interest coverage ratio, very important. Then current ratio, and last is quick ratio. So all of these are financial variables. Then we have some behavior variables. You should know all these variables because these are important whenever you are building a model. Variable is something you should be always having in your mind, on the head of your mind, because whenever you are explaining in your interview, these variables are very widely asked questions. Okay. So in behavior variable, we will check DPD, day past due. Okay. Number 2, number of late payments. Like how many payments bank has given late, the company has given late to the bank. That is something we check. Then average payment delay. Average payment delay, very self-explanatory. And then utilization of credit. This is again a behavior based variable. Then there are some external variable. Let's see the external variable. External variables. What are external variable? Industry based risk. Overall, the industry, the construction industry, let's say, have some risk. So that is part of industry risk. Okay. Then company age. How old is the company in terms of market reputation? How many projects they have delivered? Or there are some litigation flag. if any litigation flag in the company. Okay, then they check GST filings. How much GST the company is filing, that is again a important metrics. So there are three type of variables which I have told you: financial variable, then you have behavior variable, and then you have external variables. So all of them are very important to create your input data prepared, because before creating the model, you need to have all these variable handy. And we have spoken about the total steps involved. Now let's go one by one and understand the whole modeling concept across all these 16, 17 steps which we have. One more thing, before we go in the steps, you should always understand that there are different type of loans. Okay, so it's not necessary that all these 17 steps will be used in every loan. It's not mandatory. Okay, that is something we should be knowing. Now let's move forward. Just think that Prestige Group want to develop a whole city in Bangalore. So for that, they need some mega township amount, right? To create that whole city, right? Because they would be building some residential apartment, then roads, utility, supporting infrastructure, and all everything, right? So everything would be part of this whole conglomerate and a single group. Now, as I said, let's assume the project cost total is 10,000 crores. 10,000 crores. Now, the promoter, the company is contributing. So let's say I'll call the promoter. Promoter is who? The Prestige Group. They are putting 3,000 CR. Okay. Now, bank financial requirement which the promoter have from the bank is close to 7,000 crore. Okay. So we can say this is the debt. Debt from bank. That is your 7,000 crores. Now the question is, how does a bank decide whether to lend this 7,000 crores or not? The answer actually lies in the infrastructure credit lifecycle, which I have explained to you, right? So let's walk through those steps. So the number one step which I told you was deal origination, then due diligence, then project feasibility assessment. So let's talk about these now. So you know the scenario, right? How much money we have, how much money the promoter is ready to invest. So you know that now. Now let's talk about the step number one. So step number one is like deal origination. Deal origination is what? Is the process through which a borrower first approaches a bank. Okay, that is the deal origination process. And bank also have those employees who are looking for such kind of big deals for the bank, because they know the bank is going to make a huge profit out of this. Okay, now the Prestige Group approaches the bank that we are building this city, sir. So we would be needing this much of money, this much of amount we are putting as a promoter. Now bank need to assess. So who is the borrower, what is being built, how much funding is needed, what is the expected completion timeline, what is the purpose of the borrowing, all these things will be checked by the bank. Now the objective is to understand the financial requirement and initiate the credit evaluation process, because once you don't have answer to all these things which I just said, then you would be going for the next step. So next step is your due diligence. Now step number 2, origination has happened, bank has been informed. Step number 2. Now in step number 2, due diligence is what? Due diligence is the investigation process conducted by the bank to verify the credibility of the borrower. So here you check the credibility of borrower. How you'll check that? So bank actually reviews everything. So bank would be doing the borrower due diligence by financial statements. Okay. So bank will be checking financial statement, like their balance sheet and their profit loss statement. Any existing debt on the bank, any existing debt is there or not, then they will check past repayment history. Past repayment history will tell about the behavior of the bank. Then previous project execution track record. So you can say track records. Why we are doing all this? For the step due diligence. For due diligence, we are doing all this. Now, bank would be doing project due diligence. This is only on the level of the company. So the bank will go to the property level due diligence. In that, what they will check? They will check certain different parameters like land ownership. That every litigation of the land ownership is clear or not. Environmental approvals from the local bodies are clear or not for the builder or for that particular project. Government permissions. Government permissions. This is again checked. Then any legal clearance is pending or not. So now bank has check on the level of the group, on the level of the project. Okay. Now, if I give you an example sort of thing for this, so bank verify whether Prestige Group has successfully delivered the past projects or not, which they have built across Bangalore, for example. So they will check their previous project life cycle, if there are any complaints, what are the issues. So objective is to ensure the borrower and project's litigation is completely checked or not. So it has to be checked. Okay. So this was the step number 2. Now, step number 3. What was step number 3? Feasibility assessment. Feasibility assessment. Feasibility assessment. Yeah. So what is feasibility assessment? Feasibility assessment means it determines whether the project can generate sufficient cash flow. Okay. The sufficient cash flow or not. Sufficient cash flow can be generated to repay the debt obligation. To repay debt. Okay. This is again very important. Now, each every area will be evaluated. We have done some assessment already. So this will check the technical feasibility. Can the project physically be completed or not? If there are any issues in that area, let's say we cannot build a building very close to a lake or something like that, they will check then technical feasibility, commercial feasibility. They will check the economic feasibility, that how much the builder is planning to sell the flat, is that feasible in that area or not. The bank estimation, number of the apartment, number of the selling units, what is the price, demand in that particular area, everything, all these things will be checked by the bank. Now the critical question which is at this stage is, will the Prestige Group generate enough cash flow to repay that 7,000 crores? End goal, simple, period. That's the whole and soul of this story which I have just told to you. Now this is the step. This was the step number 3. Now step number 4. What was the step number 4? Financial modeling. Here we are going to do financial modeling. In financial modeling, what is financial modeling? Financial modeling involves the forecasting of the future financial performance of this particular project which the Prestige Group is going to build. Now, why it matters? Because bank do not lend based on today's number. They lend on the basis of the future cash flow which the company would be earning. So bank always invest in the future, not in the present. That's the simple logic. Now, when you would be building the model, see, in this video, I will try to incorporate all the concept, and in the second video, I will make a model using the coding and everything. We'll execute the model. Okay. But you focus on the concept so that you will be able to understand the code when I will be explaining it. Now, model would need some inputs. What are those inputs? Because whenever you are building a model, the model is run on certain columns. So let me clean this. Yeah. So when you are preparing the financial modeling, you would need inputs. I explained to you financial inputs, behavior input, external input. At this stage, what you want? You want sales volume. Okay. You need selling price of the flat or whatever you're building. Construction cost. What is the construction cost? What is the return? What will be the inflation? This is very important. Then interest rate. What is the interest rate they are offering? Repayment schedule. Repayment schedule. Very important variable. Again, the last one is occupancy rate in that area. What is the meaning of occupancy rate? That if Prestige Group is selling the flat and the people in that area, they don't want to stay because this is like 20 kilometers outside the main area. So now there would be less chances that the flat will be sold immediately. Although builder try to make their image that everything is sold on day one itself, they have like 80% of the inventory left. On day one only they get limited amount of selling, but they try to showcase that. Although that's a different discussion. Let's move back. So now what would be the output? There will be some dedicated output for this. So what will be the output after the modeling? You will predict the revenue. That's the end goal. Revenue forecasting. EBITDA. Forecast. Everything is forecast. Because that's what you're trying to achieve, right? Cash flow. Forecast. Revenue, EBITDA, and cash flow. Then debt, repayment, forecast, not history. Okay, so these are the output variable which are generally calculated after creating the model. Now the bank create a 15-year-old model forecasting cash flow from their previous project and their commercial rental income, everything they consider to estimate future cash flow which will support repaying this loan. Okay, now the next step involves, let's talk about the step number 5. Step number 5, let's go a little more down. You have step number 5. So what was step number 5? Credit risk matrix. What is credit risk matrix? So I said DSCR number 1. What is DSCR? DSCR is debt service coverage ratio. Debt service coverage ratio. What is this? This measures how comfortably project cash flow can cover debt obligations. Okay, so DSCR has a formula. So you can say DSCR equal to cash available for debt, cash available for debt divided by debt service. This is the equation. Simple. Now, let's say assume your cash flow is 15,000 crores, debt repayment is 1,000 crores. So DSCR will be 1.5x. Okay, DSCR equal to, let's say, 15,000 divided by 1,000, which will be able to 1.5 I consume, and then 1.5x. Now, interpretation is for every 1 rupee owned to the bank, Prestige generates 1.5 rupees. That's what it means. For every 1 rupees, this is something they will be able to generate. So there would be a profit of 50%. Okay. So bank usually prefer DSCR greater than or equal to minimum 1.2. So bank want, if they are investing 1 rupiah, they should be able to get at least 1.2. That is the end goal for this particular DSCR matrix. Now the second matrix I was talking about is LLCR. What is LLCR? Loan life coverage ratio. Loan life coverage ratio. What is loan life coverage ratio? It basically measures whether the entire project lifetime cash flow can repay total outstanding debt. That is the concept here. Now, LLCR also have a formula, present value of the future cash flow. Present value of future cash flow, not current, future cash flow divided by outstanding debt. How much debt is still outstanding? So this is the formula, just like this one. Now just assume you have a future cash flow of, let's say, 1200 or 12,000 crores. Just assume, you need to understand the multipliers here. So now this 12,000 crore and the debt outstanding at stage 0 is 7,000 crore. Okay. Now if you divide this, you will get 1.71x. Higher LLCR means safer lending. Bank usually prefer more than 1.2 again in this case. Okay. But here you are receiving close to 1.71 CR. Just understand the concept, guys. Okay. Because once you'll run the code, you will get all these things automatically within seconds, because programming language works really fast. When you're calculating it on the paper, this is going to be taking more time. But when you would be doing it in the programming language, this will be done like this. You will see in like 5 seconds. So now the next matrix after LLCR was project IRR. Project IRR. Now what is that? Internal rating return. Internal rating return. Now, what is the meaning of this? This is the third matrix. It means that the expected return generated by the projects over its lifetime. That's what it means. So project IRR can be any percentage. For example, you can assume IRR percentage is 18%. So what is the interpretation of this? The project is expected to generate 18% annualized return. Annualized return. Now, the important thing, these three metrics are always must calculate. We should be calculating depending on the model and depending on the bank and depending on the project, so many aspects. Okay. But these are the metrics you should be knowing when you're going for your interview and you are appearing for a B2B credit risk interview. Now let's talk about the next step, which is your step number 6. So step number 6 is internal credit rating. Internal credit rating. In the internal credit rating, internal assessment is done by the bank for the borrower creditworthiness. The borrower is Prestige Group, so they will see so many different factors like financial strength, how much the group is leveraging the money, their history in the past, then industry risk, project risk, management quality, all those things. Okay, it's not mandatory that you will see all these physically all these steps are there in your SAS code or your Python code, but you will see that the concept have been used in the back end, but maybe some of them are not implemented directly because it's not required sometime. But this internal rating is always mandatory, because without the internal rating, you will not be able to categorize your clients bucket, right? Because you are not only giving the loan to Prestige Group, you are giving to so many other builders also, right? Now, you will rate the builder also. For example, category 1 you have, then category 2 you have, then category 3 you have. So let's say Prestige Group is part of your category 1. Okay, so that is a good grade builder. Similarly, some builder you will put here, some builder you will put here. So it would be kind of a segmentation, grouping, whatever you want to call it. Okay. The purpose is because you want to understand the pricing. You want to understand the approval levels, because a grade A builder will not be defaulting very easily because you have checked everything from their past. So capital requirement can be refilled easily because the builder have a good credit worthiness, and then they have good cash flow, they have good balance sheet. Expected loss estimation also will be less in the big builder because they have great assets, they have great reputation at stake. So they would be not doing those small mistakes usually. Okay. Now the next step is about the PD calculation. Next step talks about PD. PD, I have explained so many video on this channel. PD measures the likelihood. Let me tell you in single line. PD measures the likelihood that the borrower will fail to repay the debt obligations within a specific period of time. That's what PD means. So if the PD is equal to, let's say, 2%. So out of 100 similar projects, 2% builder will default. So that means out of 100 builder we gave the loan, 2 must have defaulted. Now, what is the use? You will say, what is the use of this part? This tells the bank that you have been following Basel guidelines. or you are following IFRS 9 guidelines. You are checking risk pricing. So you are fully updated on the balance sheet or what the loss may come in future. Okay. And you check economic capital for the project. So this is the step number 7 where you calculate the PD. Okay. This is PD calculation is a common step, I would say, because in normal credit risk where you have a retail credit risk also you calculate the PD. Now you have the step number 8. Step number 8 is credit approval process. Credit approval process. What is the meaning of credit approval? Formal approval from the bank higher authority that they are willing to give this 7,000 crores to Prestige Group. Now, who are the participants? The relationship team, bank relationship teams. Okay, not the any other way around. Relationship teams, bank relationship team. Then you have your credit analyst team who are doing all this analysis for the bank. Then you have a risk team. They are assessing the risk owned by the Prestige Group. Then senior management committee. These are all the senior involved from the bank that they can see that we are lending like this big amount to the Prestige Group and it will be able to pay. So multiple factors are involved like risk, cash flow, security structuring. All these parties are talking to each other for this one loan. The approver would be this senior management committee. They would be the approver after checking each and every aspect of this. And this, there are so many credit risk analysts involved here, then risk analyst involved here. They have directors. So these director reports to all these MD who are part of this group. And these MD basically give the approval. So board of directors approve, kind of CXO's level employee, like all the senior executive and all of them, right? So this was the credit approval process. Now, next step is restructuring. So we talk about step number 9. Loan structuring, not restructuring. That was the later step. My bad. Loan structuring. Now in loan structuring means that loan structure you will be deciding as a bank. So you determine how the financially the company would be paying, like what would be the structure of the loan. Okay, like here you have a loan of 7,000 crore and what would be the tenure? Nobody knows. So bank will be calculating that. So for this 7,000 crores, bank says I can give you for 15 years. Prestige also expected, yeah, we are good with 15 years. What would be the interest rate? 10%. Okay. What will be the moratorium? Moratorium is a concept that you cannot pay the capital back for how much time? That is your 3 years. In big profit, bank always put this concept of moratorium. That is very important. Now, what is moratorium? Let me give you a kind of a 1 or 2 liner definition so that you always remember that. A period where the principal cannot be repaid. You cannot repay the principal amount to the bank. That is known as moratorium. Okay. The reason is because Prestige Group cannot repay before the apartments are built or sold. It's not that they got some profit from somewhere else, so they give it to bank and then they are making the money by themselves only. Bank always make sure that I should get the profit. Okay, so this is the loan structuring concept. Now, next step, a very important step is the syndication. I hope moratorium is clear to all of you. Moratorium is a concept which is used again in different teams. Okay, in mortgages, normal, sometimes in the retail mortgages also when you are getting like big loans, right? Okay, the next concept is syndication. Now, what is syndication? Obviously, the first question will come to your mind. What is the meaning of syndication? When multiple banks join finance as a large project, because multiple bank want to participate because HDFC said, let's say I cannot give the full loan by myself. Okay, so they invite ICICI, they invite some government bank, they invest some like small finance bank, all of them. So what they will do, they will do some kind of a mathematic. They will say that I am HDFC, I am a big bank, I can give like, let's say 4,000 crore, but 3,000 crore is still required. So they called, let's say, some small finance bank. He said I can give 500. Then a government bank also joined them. He said we can give 2,000 crore. Again, we have 6,500. Then again one more bank come, bank D. They say I can give 5,500. So now they have a total of 7,000, which is needed by Prestige Group. So this is, we are doing syndication for risk sharing, so that the whole risk is not in the books of a single bank. That's the concept which is used, syndicate accounts, or sometimes we call it consortium formation. Okay, this step is again a very theoretical but conceptual step which you should know. Now what will happen? Now everything is ready, loan is ready, so many bank has come. So the next step is loan disbursement. Loan disbursement. Everything is checked, model is built, PD is checked. So many parties has come that I am contributing. Now funds are released stage wise. Stage means, let's say Prestige Group say will put first we will build 4 floor, then 8 floor, then 12 floor, then 16. So after every stage they will release some amount, bank will release the amount. Okay, so let's say they say first you, now let me give you a real example. So bank will say first you go for land acquisition. So once land is acquired, we will release 500 crores. Then you build the foundation of the whole project. Then we will release next 1,000 crore. Similarly, once your construction is 25%, we'll give you another 500 crore. Then you have 50% construction, again 500 crore, so and so. It keeps on going depending on the different type of banks and different type of structure. Now next step is construction monitoring. Bank is doing all this, guys. It's not only Prestige Group is checking your houses, it's bank also checking. Okay, because bank is investing so much money in all this, although from your own from your pocket only, because bank don't have money, bank have only our money only. So bank is giving loan from our money which we are putting in our savings account and all of that, right? I hope you understand that whole business model, because bank is usually making profit out of somebody else's money and still they're making money in terms of interest. Okay, now the construction monitoring. What is the meaning of this? What is the need of this? Because bank always check, there is a continuous monitoring required, that the builder is able to meet with the obligations, whatever they commit, they are able to execute or not. Now risk monitoring is important. It checks the delays. If there are any delays happening, so they check that. Delay is very important. They check if there any cost revision for customer, for bank, for material, anything. Any contractor is failed or not. Contractor failed. Because one company is giving contract to so many people, it's not only the Prestige Group who's building it, so many other contractors are involved. Any litigation in between the project, any litigation is not going worst. Any regulatory issues, like the group has taken the permission for 20 floor, then they are building 22 floor, something like that. So these are the some example. Like let me give you one more very interesting example. So the original budget was 10,000 crores. Okay, now the bank has seen that the actual budget has gone 13,000 crores. Now this creates a significant repayment risk for the bank. This also happens, right? Some material change has increased the limit, or the cost of inflation, or the product cost has increased, or any material cost has increased. Now the objective is here to detect any emerging problems and make your mind to solve them before they rise and hit you hard. That's the point. Now next step is 13th step. 13th step is bank would be preparing a early warning system. What is the meaning of early warning system? Early warning system. It's in every industry. Bank prepare kind of a framework to identify the signs of borrower is under stress. Okay, that Prestige is under stress because of so and so reason. Financial indicators, operational indicator, market indicator, anything can be there. So financial indicators. I'll tell you what is financial indicator. Then you have operational indicators. What was the last one? It was the market indicators. All of them have identity. Let me tell you how to identify them now. So financial indicator are falling cash flow of the builder. That is again very big indicator. Then increasing leverage. So these two are like kind of a very common financial indicator. Then you have construction delay as a operational indicator because of any reason, like COVID happened. Construction delay. So all the labor went to their house and there was construction delays and all that, right? Then this is one of the example, the COVID for construction delay. Then you have low sales velocity. The sales is not up to the mark and then the project launched, so it's not able to meet the kind of sales we were expecting. Then market indicators like rating downgrades. The rating for the bank I showed you, right? A rating, B rating. So bank rating has been downgraded because of any reason. So the rating, it has shifted from A bucket. Now this builder has come to bucket B. So that kind of situation. And then negative industry trend. When the whole industry is going negative, for example, in 2008, the whole home lending portfolio was totally gone. So all the home loans were flouting the rules at that point of time. Now, when industry goes wrong, there is nothing the builder can do. Whole construction sector will fall. So apartment sales going slow significantly, project cash flow begins distorting, or any kind of account level flag for enhancing the monitoring. So all these are part of the early warning system for the bank. Okay. Next step is step number 14. Step number 14 is ECL calculation under IFRS 9. Or if the bank is following Basel, sometime they would be following kind of a different approach, but the core concept stays the same. They will be checking the ECL. Now ECL formula is very famous. ECL equal to PD multiply by LGD multiply by EAD. Simple. PD stands for probability of default, LGD stands for loss given default, and then EAD exposure at default. So let's say the default occur on 100 rupees. Just assume. Let me give you an example. The default happens on 100 rupees. Now, loss for the bank is, for example, 40 rupees. So that means LGD is 40%. Okay, I hope this is clear. I have already told you about the PD. Let's say PD is 2%. That means the out of 100, 2% people are defaulting. So let's keep that. PD 2%. Now loss given by default is 40%. Now EAD, exposure at default, in the starting was how much? 7,000 crore loan we have given. So 7,000 crore was the EAD. Now once you calculate the ECL, you need to multiply 40 multiply by 2 multiply by 7,000. So once you multiply all this will close to 56 crore. It will come to 56. So that means bank should provision approximately 56 crore for future loss. That is your ECL calculation. Okay. Now let's talk about the next step, which is your step number 15. So what is step number 15? It stands for the loan repayment and portfolio monitoring. So you can say portfolio monitoring. Bank has to monitor the portfolio. The period during which the bank or basically the projects generate the revenue and repaying all this debt, that whole tenure is portfolio monitoring is going on in the back end, because right from the origination till the end of the debt payment, the life cycle of the loan is constantly going. So the bank usually check the outstanding balances and all. It's constantly checking all that. Then collection performances, they are checking DSCR ratio, which I just told you. Then they are checking the balance sheet, or I can simply say financial statements. Balance sheet is part of that, and then they see the profit and loss statements. Continuously monitoring, okay, project cash flow. All these things are part of the monitoring, and that's why this step is constantly step. This is kind of a continuous testing which is going on in the backend. Okay. Next step is the restructuring. As I said, if bank see any red flag, restructuring of the loan. Now the restructuring of the loan is to modify the structure of the loan, which I said in the starting. Modify the loan structure. If you see any stress is coming, to avoid any stress. That's why we do stress testing also sometimes, okay? To avoid any stress, bank do some restructuring, like extend the tenure. So they decided the tenure 15 years in the starting. Bank said now you can pay in 17 years. This is one restructuring. Reduce the installments, again second method. Grant them the payment holidays that you can skip this one and then you can pay at this particular date. Then refinement of the debt, so many things, but the most common is extending the tenure, giving them more chance to pay. So real estate market slow down, there are any reason, let's say the bank see that the real estate market is slowing down and Prestige is not able to sell all the flats. Apartment sale is declined because of the market and on temporary level. So instead of focusing on default, bank do the repayment restructuring. Okay, it's easy for the bank to give them the chance to sell it and come back with the profit. Now the last step, which is your step number 17. What is your step number 17? Last is what? At the end, it will either pay the money or it will default. After default, what will happen? Recovery. So default and recovery. Default occurs when the borrower fails to meet the repayment obligation. Simple. They are not able to pay the money. They said we don't have money, we cannot pay it. That is default. Now recovery will come into the picture. Bank will activate the recovery people that go recover the money from the Prestige group. So they will sell their assets which they kept as a mortgage. They will take any legal actions, legal proceedings in the courts, and then they acquire something. Then insolvency process. Insolvency also is a process. You can read about it, you will understand. Insolvency process will be initiated. Change of project ownership, that's usually happens. Change of ownership. Now, let's say Prestige Group defaulted. So the Prestige City will be renamed under HDFC City. Just on a lighter note, guys. So that's what usually happens. Okay. Now the Prestige City is failed completely. Let's say if they default only. I'm just taking a hypothetical case. So now the recover maximum amount and go for legal proceeding. And other than that, rename the property. Now we are the owners. Okay. So now these were the steps involved in B2B credit risk scenario. I hope you totally understood all these steps. Okay, now this is the complete infrastructure level credit risk portfolio which I decoded for you, and why I took a real life example from, let's say, Prestige City Bangalore, which is already there, because these kind of loans are the biggest loan which bank usually gives. Okay, other than obviously investment banking, these are the corporate portfolios and B2B lending we call it. Now all these steps are important, and when you're building the model you need to keep all these steps in your mind. Okay. Now on that note, I would request all of you, if you found this video helpful, make sure you subscribe to this channel and support me in making more video. And the second part of this video would be coming very soon, where I would be showing you the real SaaS code which we would be running step by step, and we'll understand how this whole portfolio works. Okay. Now to summarize this video, let's just go on the top. I think we are clear now with the B2B part of the credit risk, how B2B works, what is the difference between B2B and B2C. On that note, I would take a leave from all of you. Please subscribe to my channel and please share this video with all your friends and your colleagues. Thank you so much. All the best.